Most traders think that after 20 trades, they'll finally know if their system works. They're obsessing over win rates, profit curves, and whether they picked the right strategy. But here's what actually happens. After 20 consistent trades, you don't discover if your system works. You discover if you can work. Because trade number 21 isn't when you validate your edge. It's when you realize you've been building something completely different. Your brain has been cataloging patterns you can't see yet, creating neural pathways that separate forced trades from valid setups, and most importantly, training you to execute while your emotions are screaming at you to do the opposite. The traders who quit at trade 12 aren't failing because of bad strategy. They're failing because they never stayed consistent long enough to build the internal database that makes consistency automatic. I learned this after 2 years of accumulating hundreds of trades but zero actual consistency, constantly switching systems like someone trying to learn 20 languages at once. What I'm going to show you is why those first 20 trades aren't about making money at all. They're about rewiring the relationship between your system on paper and your ability to execute it under real conditions. And once you understand what's actually being constructed during this process, you'll stop searching for better indicators and start building something far more valuable. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let me start with something that sounds simple but will fundamentally change how you approach your next 20 trades. Think about the first time you drove a car. Your hands were probably gripping the steering wheel at 10 and 2, your eyes darting between the speedometer, the rear view mirror, the side mirrors, the road ahead. You were consciously thinking about the pressure on the gas pedal, when to signal, how much to turn the wheel, whether that car in the adjacent lane was getting too close. Every single input demanded your full attention. Your brain was drowning in information it had to process manually. Now think about how you drive today. You're probably having conversations, listening to podcasts, planning your day, all while navigating traffic, changing lanes, adjusting speed, and monitoring your surroundings. You're not consciously thinking about each micro movement of the steering wheel or the exact pressure on the brake pedal. These actions happen automatically because your brain has built neural pathways that handle these processes without consuming your conscious bandwidth. This exact neurological transformation is what happens during your first 20 consistent trades, but because you can't see it occurring inside your skull, most traders abandon the process right before the breakthrough happens. They're at trade 11, feeling uncertain, convinced their system is too simple or missing some crucial component, and they restart with a new approach. What they don't realize is that their brain was in the middle of building something invisible but incredibly valuable. During those first 20 executions, your subconscious is cataloging thousands of micro-patterns. How price behaves in the 2 candles before your entry trigger fires. What valid setups look like when they're forming versus what almost setups look like when you're forcing the trade because you're bored. The specific feeling in your chest when you're about to take a revenge trade versus when you're following your system objectively. The way your hands hesitate over the keyboard when you know you're breaking your rules but want to enter anyway. You're not just learning chart patterns. You're building an internal database of sensory, emotional, and cognitive data that your brain will reference automatically in future trades. But here's the critical part that destroys most trading careers before they start. This database only becomes functional after consistent repetition with the same rule set, not sporadic attempts scattered across 5 different strategies. I spent 2 years proving this the hard way. I'd take 11 trades with one system, then switch after a losing streak, then 14 trades with a modified approach, convinced I'd found the missing piece. Then 8 trades before another complete overhaul. I accumulated over 300 trades in those 2 years, but I had 0 consistency. I was like someone spending a week learning Spanish, then a week on Mandarin, then a week on Arabic, and wondering why they couldn't hold a conversation in any language. My brain never had the concentrated repetition needed to move any system from conscious effort to automated execution. The shift happens around trade 15 to 20, but you won't feel it as it's happening. You'll feel doubt. You'll feel like everyone else has figured something out that you're missing. You'll see traders on social media posting wins with indicators you've never heard of, and you'll question whether your simple system is enough. This is the exact moment most traders quit. Not because their system doesn't work, but because they can't tolerate the discomfort of not knowing yet. But let's talk about what you're actually constructing during these 20 trades, because it's not what you think. Most traders approach their first 20 trades as a profit center. They're tracking their win rate, calculating their return, comparing their results to what they expected. They think they're testing whether the system works. But here's the truth that will save you years of frustration. Your first 20 consistent trades are a data collection exercise, not a profit-making operation. You're not trying to prove your system works. You're trying to establish a performance baseline. You need to know your actual average win size, not your theoretical projection. You need to know how long you typically hold trades in practice, not in your backtest. You need to know where your discipline actually breaks down, not where you think it might break down. You need to know the specific market conditions where you're tempted to override your rules and the specific emotions that trigger that temptation. This data is completely worthless if you change variables every few trades. If you take 3 trades with a 1.2 risk-reward ratio, then switch to 1.3 because the first 3 lost, then try a different entry timing after 2 more losses, you're not collecting data anymore. You're adding noise to noise. You can't fix a system if the system isn't consistent. And you definitely can't fix your execution if your execution approach changes every time you feel uncomfortable. Think about it like this. If you were trying to measure the fuel efficiency of a car, but you changed the tire pressure after every tank of gas, modified the engine after every other fill-up, and drove different routes each time, you'd never know the car's actual efficiency. You just have a collection of meaningless numbers that tell you nothing about the vehicle's true performance. That's what most traders do. They generate hundreds of trades with no clean data because the variables, mainly their own behavior, shift constantly. After 20 identical executions of the same setup with the same rules, you finally have something meaningful to analyze. You know that when your system says enter, you actually enter about 85% of the time, and the other 15% you hesitate because of a specific fear pattern you've now identified. You know that your theoretical stop loss of 1% actually averages 1.3% because you occasionally move it after entry when price approaches too quickly. You know that your 1.2 target gets hit about 45% of the time, but you exit early on about 20% of winning trades when the profit reaches 1.5R because you're afraid of watching the gain disappear. This self-knowledge is worth infinitely more than any indicator or strategy upgrade, because it reveals the gap between your system on paper and your system in practice. Most traders never collect this data because they never stay consistent long enough to make the collection meaningful. They're constantly optimizing the system instead of first understanding how they actually execute it. And here's where things get interesting in a way that most trading educators won't tell you. After those 20 consistent trades, you develop what I call setup literacy. It's the difference between reading individual letters and reading complete sentences at a glance. Early traders analyze candles the way children sound out words, one letter at a time. They're checking criteria sequentially. Is there a trend? Check. Is this a pullback? Check. Is volume confirming? Check. What's the risk-reward ratio? Check. Each element requires conscious evaluation. After 20 consistent executions of the same setup type, your brain starts processing all of this simultaneously. You look at a chart, and you immediately know whether your edge is present or absent. Not because you're smarter or more experienced, but because your subconscious has seen this configuration enough times to recognize the complete pattern without breaking it into components. You're reading sentences, not spelling them. This doesn't mean you suddenly win more trades. It means you waste dramatically less mental energy on analysis, which frees up cognitive resources for the things that actually matter: execution and management. You're no longer exhausting yourself, trying to remember if you checked every criterion. You're spending that energy on managing your emotions when you're in the trade, or identifying when you're about to force a setup that isn't actually there. If you're finding value in this different perspective on trading consistency, consider subscribing so you don't miss the next insight that might save you years of trial and error. We're building a quiet room for traders who want depth over hype. Now let me tell you about the most undervalued realization that happens somewhere around trade 18 to 20, and it's going to sound almost disappointing when you first hear it. Professional trading feels boring. Not challenging boring or frustrating boring, but mundane boring, like brushing your teeth or checking your email. The setup appears, you take the trade, you manage it according to plan, you exit, you journal it, you move on. No drama, no electric excitement, no feeling like you're about to hit the lottery. And here's why this matters more than you realize. That excitement you felt on your first few trades, that rush of adrenaline when you clicked the buy button, that's not engagement. That's a symptom of inconsistency. It's your body's stress response to uncertainty. It's the feeling of gambling, not trading. When execution becomes boring, it means you've moved risk from an emotional event to a mathematical input. You're no longer taking trades like they're lottery tickets. You're taking them like you're following a recipe you've made 20 times before. Most traders mistake this boredom for a problem. They think they've lost their edge or their passion. They start looking for more exciting setups or more volatile markets. But boredom in execution is exactly what you should be aiming for. It means your system has become your default response, rather than something you have to constantly convince yourself to follow. It means the internal negotiations that consumed massive amounts of energy in trades 1 through 10 have faded. It means you're operating from pattern recognition rather than analysis paralysis. This shift happens in your management phase too. When you're comfortable with your system, you're far less likely to tinker with a trade mid-flight. You're not moving your stop-loss because price got close. You're not taking profit early because you're afraid of losing the gain. You're not adding to the position because you're convinced this is the big one. You're just executing the plan, and that execution feels unremarkable because you've done it 20 times already. But the deepest transformation that occurs during these 20 trades is something most traders never articulate, even after they experience it. Your identity shifts from outcome-dependent to process-dependent. In your early trading, your confidence rises and falls with individual results. You win a trade, you feel like a genius. You lose 3 in a row, you question whether you should be trading at all. Your self-worth as a trader is completely tied to the last trade's outcome. After 20 consistent trades, something fundamental changes. You're no longer confident because your last trade won. You're confident because you've proven to yourself that you can execute your system regardless of how you feel. You've taken trades while scared. You've exited at targets while greedy. You've followed your stop-loss even when you were convinced the market was about to reverse back in your favor. You have behavioral evidence that you're capable of consistency, and that evidence exists independent of whether individual trades made money. This is when you stop seeking external validation after every loss. You're not immediately jumping on YouTube to find the secret ingredient you're missing. You're not in Discord channels asking if anyone else saw the manipulation that stopped out your trade. You're not questioning whether your broker is hunting stops or whether you should switch to algorithmic trading. You've built enough personal evidence that your questions become more sophisticated. You're asking which market conditions favor your edge and which don't. You're analyzing your execution quality rather than looking for a magic indicator. You're thinking like a business owner reviewing metrics rather than a gambler looking for a lucky charm. The 20th trade is also when you start seeing yourself differently. You're no longer someone who trades occasionally or someone trying to become a trader. You're someone who has demonstrated the ability to execute consistently under varying conditions. You've traded through winning streaks where you were tempted to increase size because you felt invincible. You've traded through losing streaks where you wanted to quit because nothing seemed to work. You've managed positions while tired, stressed, distracted, and emotional. You've proven that your system isn't just a collection of rules in a notebook, but something you can actually implement when real money is on the line. This identity shift is subtle but incredibly powerful. It changes how you prepare for the trading day. It changes how you review your performance. It changes how you talk about your trading to yourself and to others. You're no longer performing trades, hoping they validate you. You're executing trades because that's what you do. But here's the contrarian insight that most traders miss entirely, and it's the reason why 20 trades taken over 20 days creates a completely different result than 20 trades spread across 6 months. Your brain requires concentrated repetition to build the patterns that lead to automatic execution. Sporadic trading prevents the momentum needed to make your system your default response. If you take 5 trades in 1 week, then nothing for 3 weeks, then 3 trades the following month, you never reach the 20-trade threshold in any meaningful way. Each time you come back to trading after a break, your brain has to rebuild the context it was developing. It's like trying to learn a musical instrument by practicing once every 2 weeks. You're constantly restarting from a lower skill level, rather than building on the foundation you established previously. This is why full-time traders often develop consistency faster than part-timers. And it has nothing to do with screen time or market knowledge. It's purely about execution frequency. They're training their brain through concentrated repetition. They're taking a trade, reviewing it, then taking another trade the next day, while the lessons from yesterday are still fresh. They're building momentum, where each trade reinforces the identity and neural pathways established by the previous trade. The type of consistency matters just as much as the frequency. Taking 20 trades using the same core setup, but tweaking your entry criteria after each loss isn't true consistency. Using the same system, but changing your position, sizing based on how confident you feel, isn't consistency either. Trading your plan on Monday and Wednesday, but revenge trading on Friday because you're down for the week definitely isn't consistency. The power of 20 consistent trades comes from doing the same thing the same way 20 times. This allows your brain to isolate the variables that actually matter and filter out the noise that doesn't. Every time you modify your approach, even slightly, you're essentially starting from trade one again. Your brain can't build reliable patterns if the pattern keeps changing. So here's what this all means for you practically. If you're currently stuck in the cycle of system hopping, indicator collecting, and constant modification, you don't need a better system. You need to execute your current system 20 times without changes. Pick something simple enough that you can define it clearly in 5 minutes. Something you can recognize consistently across different market conditions. Then commit to 20 executions of that exact setup with those exact rules. Not 20 profitable trades, just 20 trades following the same plan. Track everything. Your emotions before entry, your execution quality, your temptation to override rules, your actual results versus what you expected, the specific moments where your discipline wobbled. This data will be worth more than any course or mentorship program you could purchase, because it's data about you, not about markets. And here's what happens after you complete those 20 trades that makes everything we've talked about actually matter in your account. You reach trade 21, and something feels different in a way you can't quite articulate at first. The setup forms. You recognize it instantly without running through your checklist consciously. You enter. You manage it according to plan. You exit. You journal it. And then you move on. No internal debate about whether you should have waited for more confirmation. No second-guessing your exit. No searching through trading communities for validation that you did the right thing. Just execution. That's when the real insight hits you. Everything you'd been chasing, all the complex indicators, all the secret strategies, all the courses promising the Holy Grail, they were distractions from the actual work. The markets didn't change between trade 1 and trade 21. You changed. And that difference is everything, because here's what most traders fundamentally misunderstand about edge in the markets. They think edge is something you find in a chart pattern or an indicator combination or a specific strategy. But edge isn't something you find. Edge is something you build through the disciplined repetition of a defined process. A mediocre system executed with perfect consistency will outperform a perfect system executed inconsistently every single time. The markets don't care how sophisticated your analysis is. They reward consistency and punish inconsistency with brutal efficiency. This realization was humbling for me because I'd spent years studying complex strategies, collecting indicators, optimizing entry techniques, when what I actually needed to study was my own behavior. I needed to understand the specific ways I deviated from my plan. I needed to identify the emotional triggers that made me override my rules. I needed to build trust with myself that when I said I'd do something, I'd actually do it. After those first 20 consistent trades, something interesting happens with the next 20. They become exponentially easier, not because the markets get easier or because you suddenly have more skill, but because you've established a foundation of trust with yourself. You made an agreement to follow your system, and you kept that agreement 20 times in a row. This creates momentum that most traders never experience because they never stay consistent long enough to generate it. Each subsequent trade reinforces your identity as someone who does what they say they're going to do. The internal negotiations that consumed so much mental energy in trades 1 through 20 start to fade into background noise. Your system becomes automatic. It's your default response when you see your setup, not something you have to convince yourself to follow through fear or doubt. But let's talk about what this means for risk, because this is where the transformation goes from psychological to practical. In your early trades, risk feels intensely personal. A loss feels like a judgment on your intelligence, your potential, your worthiness as a trader. It's not just money disappearing from your account. It's evidence that maybe you're not cut out for this. Maybe you don't have what it takes. Maybe you should quit and do something safer. After 20 consistent trades, risk transforms from an emotional event into a mathematical input. You've watched your system win. You've watched it lose. You've seen losing streaks that your probability model predicted should happen. You've experienced the emotions of watching 3 trades in a row stop out, and you've proven to yourself that those emotions don't have to control your next action. You felt the temptation to override your rules after consecutive losses, and you've demonstrated that you can take the next trade anyway. This is where probability stops being theoretical and becomes real. Before those 20 trades, you might have intellectually understood that a 60% win rate means 4 out of every 10 trades will lose. You might have calculated your expected value and risk-reward ratios in a spreadsheet. You might have back-tested your system and seen the equity curve. But intellectual understanding and experiential knowledge are completely different things. Experiential knowledge is what you have after trade 15 stops out, and trade 16 stops out, and trade 17 stops out, and you take trade 18 anyway because you understand that this is exactly what's supposed to happen sometimes with a system that wins 60% of the time. You've lived through the losing streak. You've survived it emotionally. You've proven that you can continue executing when every instinct is screaming at you to stop. This experiential knowledge changes how you think about individual trades. You stop viewing each trade as a critical test you need to pass. You start seeing each trade as a single data point in a much larger sample size. One losing trade doesn't mean your system is broken. 3 losing trades in a row doesn't mean you need to find a new strategy. It just means you're experiencing normal variance within a probabilistic system. And here's where traders who complete 20 consistent trades develop an almost unfair advantage over those who don't. You now have your personal performance baseline, not theoretical projections from a backtest, not someone else's results from a course, your actual data from your actual execution in current market conditions, with your actual psychology in play. You know that your system's theoretical average win is 2R, but your actual average win is 1.7 because you tend to exit slightly early when trades move quickly in your favor. You know that your theoretical average loss is 1R, but your actual average loss is 1.1R because you occasionally move your stop after entry when you're nervous. You know that you execute about 80% of valid setups because the other 20% appear during times when you're tired or distracted or still processing emotions from a previous trade. This gap between theoretical and actual performance is where most traders blow up their accounts. They size their positions based on theoretical risk, but they execute with actual behavior that doesn't match the theory. They think they're risking 1% per trade, but they're actually risking 1.5% because of behavioral leakage they haven't measured. They think they have a 2.1 reward risk system, but they actually have a 1.3.1 system because of their tendency to take profits early. After 20 consistent trades, you can see this gap clearly. And once you see it, you can either adjust your position sizing to account for your actual behavior, or you can work on improving your execution to close the gap. But you can't do either until you have clean data, and you can't get clean data without consistency. Now, let me tell you about the moment that separates traders who build careers from traders who stay stuck. It's not about the money you make or the win rate you achieve. It's about what happens when you hit a losing streak after you've established consistency. Because losing streaks will happen. They're not a bug in your system. They're a feature of probabilistic outcomes. The question is whether you've built the foundation to survive them. Before your 20 consistent trades, a losing streak sends you into crisis mode. You start questioning everything. Is the market different now? Did something fundamental change? Is your system broken? Should you add a filter? Should you try a different time frame? Should you switch to a completely different strategy? You're drowning in uncertainty with no anchor to hold on to. After your 20 consistent trades, you have that anchor. You've seen what your system looks like when it's working properly. You've seen what your execution looks like when you're following your plan. You've collected enough data to know whether this losing streak falls within the normal variance of your system, or whether something actually has changed that requires investigation. You're asking different questions. Instead of, should I abandon my system, you're asking, does this losing streak exceed the statistical expectations of my system? Instead of, what should I try next, you're asking, am I executing my system correctly, or have I started deviating from my plan? Instead of looking for external solutions, you're reviewing internal execution quality. This is the difference between a trader and a gambler. A gambler experiences a losing streak and looks for a new game. A trader experiences a losing streak and reviews the data to determine whether they're witnessing normal variance or system breakdown. And you can only make that distinction if you have enough consistent data to establish what normal looks like. Here's something that happened to me around trade 35 that crystallized all of this. I took a setup that looked absolutely terrible to my eyes. My system said enter, but every instinct I had was screaming that this trade wouldn't work. The chart pattern looked weak. The volume was questionable. I had a bad feeling about it. But I'd committed to following my system, so I took the trade anyway. It stopped out quickly. A clean 1R loss. And in that moment, I realized something profound. I wasn't upset. I didn't question my system. I didn't feel like I'd made a mistake. I'd followed my process exactly as designed, and the outcome was simply part of the statistical distribution I'd signed up for when I chose this system. The trade itself was irrelevant. What mattered was that I'd proven once again that I could execute my plan even when everything in me wanted to deviate. That's when I understood what consistency actually builds. It's not building your ability to win trades. It's building your ability to execute your system regardless of emotions, opinions, or short-term outcomes. It's building the discipline to be boring, to follow the recipe even when you think you could improve it on the fly, to trust the process you've defined over the impulses you feel in the moment. And this is why the 20-trade threshold isn't arbitrary. It's not magic, but it is meaningful. 20 executions is enough repetition to move past beginner's luck or beginner's curse and start seeing the true character of both your system and yourself. It's enough data to make preliminary assessments about what's working and what isn't. It's enough experience to build genuine confidence in your execution ability. Not false confidence based on a few lucky wins. Most importantly, it's achievable. 20 trades isn't an overwhelming commitment that requires you to quit your job and trade full-time. Depending on your time frame and how frequently your setup appears, you could reach 20 trades in a few weeks or a couple months. The question isn't whether you have time. The question is whether you're willing to commit to not changing anything until you reach 20. Because here's what I see happen constantly. A trader commits to consistency. They take 5 trades, 2 win, 3 lose. They're down slightly, and immediately they start tinkering. Maybe the entry timing needs adjustment. Maybe they should add a filter. Maybe the risk-reward ratio should be different. They take 3 more trades with the modified system. Mixed results. They modify again. 6 months later, they've taken 80 trades with no consistency because the system was different for every batch of 5 trades. They have no data worth analyzing. They have no patterns they can trust. They have no foundation to build on. They're exactly where they started, except now they're more confused and frustrated because they've been trading for 6 months with nothing to show for it. This is the trap that destroys more trading careers than losses ever could. The inability to sit still, the constant need to optimize before you've even established a baseline, the belief that if you're not constantly improving your system, you're falling behind. But you can't improve what you haven't measured, and you can't measure what you haven't done consistently. So if you're someone who's been trading for months or years but still doesn't feel consistent, I want you to consider something that might be uncomfortable to hear. You don't have a system problem. You have a commitment problem. Not commitment to trading, but commitment to staying consistent long enough to collect meaningful data. You keep restarting before the compounding effects of consistency can take hold. The solution isn't complicated, but it requires something most traders find incredibly difficult: patience with yourself. You need to commit to 20 trades with absolutely 0 modifications. Not 20 profitable trades. Not 20 trades where everything goes perfectly. Just 20 trades following the exact same rules, executed as cleanly as you can manage, with complete honesty in your journaling about where you followed the plan and where you deviated. Define your system clearly enough that you could teach it to someone else in 5 minutes. Write down the specific criteria that must be present for you to take a trade. Write down your exact entry process, your stop-loss placement, your target or exit strategy, your position sizing formula. Make it so clear that there's no ambiguity about whether a setup qualifies or not. Then execute. Take the trades your system identifies. Journal every single one. Not just the outcome, but the process. How did you feel before entry? Did you hesitate? Did you deviate from any rules? What were you thinking during the trade? What emotions came up? Where were you tempted to exit early or move your stop? What did you learn about yourself? This journaling is not optional. It's not something you do when you remember or when you have time. It's the most important part of the entire process, because it's how you transform random trading activity into deliberate skill development. You're not just collecting trade outcomes. You're collecting behavioral data that reveals the gap between who you are as a trader and who you need to become. Celebrate small wins in execution quality, not just profitable outcomes. Did you take a trade even though you were scared? That's a win. Did you exit at your planned target even though you were tempted to let it run further? That's a win. Did you follow your stop loss even when you were convinced the market would reverse? That's a win. These execution victories matter more than whether the trade made money because they're building the foundation that makes long-term profitability possible. Give yourself permission to learn from losses without immediately changing your system. A losing trade isn't evidence that your system doesn't work. It's evidence that you're trading a probabilistic system where losses are part of the normal outcome distribution. The only question is whether you executed your plan. If yes, the trade was successful regardless of outcome. If no, the trade was unsuccessful even if it made money, because you've reinforced poor execution habits. Stay the course through doubt, through frustration, through the inevitable urge to find something better, through the temptation to modify after a losing streak, through the excitement of a winning streak that makes you want to increase risk, through the boredom of waiting for your setup, through all of it. 20 trades, one system, complete commitment. When you reach trade 20, pause. Take a real moment to reflect on how different you feel compared to trade 1. Notice the patterns that have emerged in your behavior. Acknowledge the growth that's happened, even if it doesn't show up in your account balance yet. Look at your data objectively. What's your actual win rate? What's your actual average gain and loss? How often did you execute your plan perfectly versus how often did you deviate? What are the specific triggers that cause you to break your rules? Then make a decision. Do you want to continue with your system as is? Do you want to make informed modifications based on the real data you've collected? Or do you want to try something completely different? But whatever you decide, make that decision from a place of evidence and experience rather than emotion and impatience. That's the difference between a professional trader and someone who's gambling with extra steps. Everything changes after 20 consistent trades because you've finally given yourself enough evidence to trust your process, enough experience to recognize your edge when it appears, and enough discipline to execute regardless of emotions. The markets won't feel easier. They're still random and unpredictable in the short term, but you'll feel more capable. You'll have a foundation built on real data from real trades that you actually executed. Trading won't become simple. It's still hard work, requiring constant attention to your psychology and execution quality, but it will become clearer. You'll know what you're looking for. You'll know what to do when you see it. You'll know how to manage yourself during the trade. And you'll know how to review your performance honestly afterward. You won't win every trade. You won't even win most trades if your system has a 40% win rate. But you'll know you're following a process that can work over time. And that knowledge, that foundation of personal evidence built trade by trade, that's what separates traders who make it from those who don't. The journey of 1,000 trades begins with 20 consistent ones. Everything else flows from there. Your next 20 trades will be better than your first 20 because you'll be building on the patterns established in your initial 20. Your 100th trade will draw on neural pathways created during your 20th. You're not just building a trading system. You're building yourself into a trader capable of executing that system. And that construction happens one trade at a time, with one rule that matters above all else. Stay consistent long enough to see what you're actually building. Because what you're building isn't visible in your first 5 trades, or your first 10, or even your first 15. It emerges around trade 20 when you suddenly realize you're no longer thinking about whether to take the trade. You're just taking it. Because that's what traders do. So let's bring this full circle. You probably clicked on this video thinking you'd learn whether 20 trades is enough to validate your system. Whether your win rate is good enough. Whether you picked the right strategy. But that's not what 20 consistent trades actually teach you. They teach you that the system on paper means nothing until you can execute it under real conditions. That your edge isn't found in indicators or patterns. It's built through the disciplined repetition of a defined process. That consistency isn't about never feeling doubt or fear. It's about executing anyway. That boring execution is the goal, not a problem to solve. And that the gap between your theoretical system and your actual behavior is where your real work lives. We covered why your brain needs concentrated repetition to build the neural pathways that make execution automatic. Why your first 20 trades are a data collection exercise, not a profit center. Why setup literacy develops only after you stop analyzing individual candles and start recognizing complete patterns. Why outcome dependence keeps you trapped, while process dependence sets you free. And why 20 trades spread over 6 months counts for nothing compared to 20 trades taken with the frequency needed to build actual momentum. The traders who quit at trade 12 aren't failing because they chose the wrong system. They're failing because they never stayed still long enough to become the person capable of executing any system consistently. Trade 21 isn't when you discover if your edge works. It's when you discover that you've become someone who can execute their edge regardless of how they feel. Everything changes after 20 consistent trades because you change. And in the markets, that's the only variable you actually control.